Fears of a recession are looming across the country.
Jamie Dimon and David Solomon warning of a recession next year, stocks to consider in a slowdown.
Fed is a real wild card here. So they effectively inverted the yield curve to slow down economic growth. And the wild card is whether they will continue to basically, in my opinion, overshoot and drive rates up to such an extent that we put full brakes on the economy and the Fed drives us into recession.
Inflation has been weighing on everyone's mind and wallet. The debate and concerns about what a recession could look like and if the US will enter one soon is hot as well. Hello and welcome back to my channel. In today's video, Lyn Alden looks forward to 2023 and discusses what's happening to the US and China's economies, and whether we're entering a recession in 2023 or not. She also talks about Fed and rising interest rates. So stay tuned until the end of the video for more details. Now, to always stay updated with the world, the economy, and the market, go ahead and hit the subscribe button. Don't forget to hit the bell icon for more videos just like this one, and you can also go ahead and give this video a big old thumbs up if you enjoy. Let's get back to the video to hear what Lyn has to say on the recession conditions.
So I think it's been somewhat surprising how resilient so far the economy's been to recession, but I still think the picture does not look very good for 2023. It depends on a few different variables. So right now, for example, the U.S. yield curve is inverted, which means that the 10-year treasury is a lower yield than the 3-month treasury. The last 8 recessions, the yield curve inverted before the recession, and there's been no false signals, right? So it's never inverted, and then there's no recession. Now, the caveat, though, is that sometimes it's like, a recession happens 2 months later, and sometimes it happens like 2 years later. So there's a pretty wide gap for how long it can take for a recession to materialize, number one. And another challenge is that monetary policy happens on a lag because, especially in the United States and in a number of other countries, a lot of the debt is fixed rate. And so, just because mortgage rates, for example, shot up dramatically does not mean that the average American homeowner is paying a higher mortgage rate. Basically means that fewer mortgages get taken out at those higher rates. Fewer people ever want to leave or sell their current home. They want to lock in and keep their current mortgage rate. And so basically a lot of those are unaffected by the increase in rates. And so what happens is quarter after quarter, potentially year after year, as rates are at a higher level, some percentage of debt matures and gets rolled over. Like some corporate debt matures and gets, refinanced at these higher rates. Some people just have to move. Things happen, and then, so low interest rate debt gets refinanced at higher rates, and that eats into incomes. It eats into things that they otherwise could spend money on. More of it goes to bondholders, banks, things like that, and away from the non-financial industry. And that can contribute to recessionary conditions.
There's been a lot of talk about recessionary pressures and that we might be in a recession. Lyn added that we're in a slowdown for sure, and that will certainly continue in 2023. Now, US recessions have been preceded by an inverted yield curve when short-term rates exceed those of longer tenors since the late 1960s. Fast forward to 2023, that's exactly what's been happening with the Treasury yield curve in the past month and a half. We're already starting to see slowing in the economy due to interest rate hikes. A lot of it's in housing activity, which is what Lyn has also talked about. And we're also seeing consumers shift their spending away from goods and towards services. But we think services will probably be under threat. Certainly when we look at expectations, they've been signaling a recession for a long time.
We're kind of in a more stagnant environment right now, and we'll see if it descends into an outright recession. So right now, U.S. unemployment, for example, looks like it's bottoming and maybe turning up a little bit. You see consumer confidence, CEO confidence, measures like that are very low. The one saving grace that is somewhat, I think, keeping things afloat is that if you look at this year, the dollar index was soaring, which, again, to my prior point earlier in this discussion, puts a lot of pressure on the entire world. But in the second half of the year, you've had like a rollover in the dollar index. It's kind of left off some pressure, and so that's been a a constructive environment for a lot of developing countries, a lot of just indebted entities around the world, and it's given them a little bit of like a breath of life. And combined with the China's reopening, that's kind of the one variable to keep watching to say, okay, the U.S. is kind of in some ways purposely putting itself into a recession to try to regain control of inflation. But then the question is, as the market, looks at their inverted yield curve and maybe stops, paying more for the dollar, it allows these other indebted entities around the world to potentially stabilize and start doing okay. So I'm perhaps less bearish on the rest of the world than the average person is, but I still think that 2023 does have a lot of risks for recession or near recession, just overall kind of weak economic growth.
Inflation was a big problem for 2022, and it's surely going to be one in 2023. I think a lot of it is interest rate tightening by the Fed, and again, the Fed is trying to fight inflation and keep it anchored, and certainly consumers are starting to worry about their personal finances. They're hearing bad news about companies, and they're concerned about their own job prospects as well. I mean, we can all agree that things on the economy side aren't looking that bright either. Yeah, undoubtedly, inflation is weighing on the consumer, and it's definitely negative news on the economy. And there are many indicators and conditions in the market that Lyn believes could indicate a potential risk of recession or near recession this year. Now, there are many other experts, economists, and business leaders who also believe recession is coming in 2023. As per a survey, 98% of CEOs have also been signaling recession. The US dollar also languished near a 7-month low against other major currencies on Tuesday, as investors took heart that the Federal Reserve may be nearing the end of its rate hike cycle, and as China's reopening drove demand for riskier assets. So, can we see the Fed pivot? Let's get into the next clip to hear Lyn Alden's viewpoint on Fed and interest rates. But before jumping ahead, be sure to like and share.
Like if you said, how high do you think the Fed's going to be able to tighten interest rates before they start causing problems? My number was probably around 3%, but they've already been able to get up to 4%. I think part of it was how quickly they did it, because as I mentioned before, a lot of this operates on a lag. So it's almost like there's very little difference. If you go to like 0% to 3%, like in 1 year, or 0% to 5% in 1 year, that almost doesn't make a difference because refinancing activity came to a halt pretty much. And so it's almost like that extra number barely matters in the near term. Where it starts to matter is quarter after quarter as this plays out. That's where I think it starts causing issues. So I think it's a matter of time rather than just height in terms of interest rates. There's also, it's always hard to measure how much kind of excess liquidity is still in the system, right? So people got stimulus checks, they got child care tax credits, PPP loans that turned into grants. So basically millionaires were given, another like $500,000, things like that. And that's just money that's kind of like sitting there, and they kind of like drain that out over time. It starts to getting diffused throughout the economy. And so some people had higher savings rates or, higher savings stashes stored away than I think some analysts realized. And so, I think quarter after quarter, it gets harder. The comparisons get harder from prior quarters as some of the conditions, basically as conditions stay very tight. So I think that's probably one way to look at it, that these things take time.
Historically, when you have high inflation and the Fed is jacking up interest rates to quell inflation, that results in a downturn or recession. Lyn doesn't think it's going to be a very happy year. She's expecting the economy to slip into recession by the end of the year due to the lag effect of the tightening in financial conditions that the Fed has engineered here, as well as the additional rate hikes that they're signaling. Well, the scenario of the market doesn't look too good overall. We're definitely in very uncertain times. That gets us back to the question of if there's going to be a recession next year. How deep of a recession will it be, and what will be the Fed's next decision? How high do you think the Fed can tighten the interest rate? Let me know your thoughts in the comment section below. And if you enjoyed the video, be sure to like and share. Also, don't forget to subscribe to my channel for more videos on crypto, market, and economy. I'll see you in the next video. Adios, and thanks for watching.